Most people have never heard of BlackRock. It doesn't advertise, it doesn't sell products to the public, and it rarely makes headlines. Yet, behind the scenes, it controls more money than any other company on Earth, nearly $10 trillion in assets. That's more than the GDP of Japan, Germany, and the UK combined. Every time you invest in a retirement fund, take out a mortgage, or even swipe your credit card, chances are BlackRock is somehow involved. But how did a small investment firm go from humble beginnings to silently shaping the world economy? How did it grow so powerful that governments, banks, and even the biggest corporations rely on its influence? This is the untold story of BlackRock, the company that doesn't just manage money, but helps control the financial system itself. In 1988, BlackRock wasn't the financial powerhouse we know today. It was just an idea brought to life by Larry Fink and 7 other partners who had one mission: to help investors manage risk better. At the time, Wall Street was all about making big bets for big rewards, but Fink had learned the hard way that reckless risk-taking could lead to disaster. Earlier in his career at First Boston, he had been a rising star in mortgage-backed securities, but one miscalculated interest rate shift cost the firm hundreds of millions. That loss wasn't just a blow to his reputation. It was a wake-up call. He realized that in the world of finance, understanding and controlling risk was more valuable than chasing quick profits. With that lesson in mind, Fink and his team set out to create a different kind of financial firm. Unlike traditional investment companies that focused on high returns, they built BlackRock around a simple but powerful idea: risk management should come first. Their approach wasn't about gambling on the stock market. It was about using data, technology, and analysis to make smarter, safer financial decisions. BlackRock initially operated as part of Blackstone, a private equity firm. They started small, managing assets for institutional clients who wanted a safer way to invest. Their early success came from their ability to analyze financial risks better than anyone else, and soon, more investors took notice. By the early 1990s, BlackRock was gaining traction, but there was one problem: they were still operating under Blackstone. While the partnership had helped them get started, it also meant they weren't fully in control of their own destiny. Larry Fink and his team wanted to build something bigger, something that wasn't just an extension of another firm. In 1994, BlackRock officially split from Blackstone and became an independent company. This wasn't just a business move, it was a turning point. Now, they had full control over their strategy, and investors trusted them because of their strong focus on risk management. Unlike other firms that made bold, aggressive moves, BlackRock built its reputation by being cautious, data-driven, and predictable, something big clients value. As BlackRock grew, so did its credibility. Pension funds, governments, and institutions started relying on them not just to invest money, but to protect it from market volatility. While other investment firms chased high-risk opportunities, BlackRock offered stability. This approach earned them the trust of some of the world's largest financial players. In a field where reputations are built on consistency, BlackRock positioned itself as the firm that wouldn't take unnecessary risks with client money. BlackRock's real advantage wasn't just its investment strategies, it was its technology. In the 1990s, they developed Aladdin, a revolutionary risk management system that gave them an edge over every other financial firm. While most investors relied on traditional analysis, BlackRock used Aladdin to scan through trillions of dollars in assets, identifying risks that others couldn't see. This wasn't just a tool, it became the backbone of the company. Banks, insurance companies, and even central banks started using Aladdin to manage their own financial risks, turning BlackRock from just an asset manager into a critical player in global finance. Aladdin's impact was massive. By using advanced data and real-time analytics, BlackRock could make smarter investment decisions, avoid major market crashes, and provide clients with a level of risk control no one else could match. This technology became so influential that even competitors relied on it. It wasn't just BlackRock's secret weapon, it was a system that shaped the entire financial industry. In 2009, in the aftermath of the global financial crisis, BlackRock made its biggest move yet. acquiring Barclays Global Investors for $13.5 billion. This deal wasn't just about growing bigger, it completely transformed BlackRock. With the acquisition, they became the world's largest asset manager, but more importantly, they took control of iShares, the biggest name in ETFs. ETFs were exploding in popularity because they made investing easier and more accessible. And now, BlackRock controlled the biggest slice of that market. This wasn't just an expansion, it was a strategic takeover that gave them influence over how everyday people, institutions, and governments invested their money. Owning iShares meant that BlackRock wasn't just managing investments for big clients anymore, they were shaping the entire investment landscape. ETFs allowed investors to buy into different markets without picking individual stocks. And as the demand for passive investing grew, so did BlackRock's power. By the 2010s, BlackRock wasn't just a financial firm. It had become one of the most quietly powerful forces in the global economy. Because they managed trillions of dollars, they were now the largest shareholder in some of the world's biggest companies: Apple, Microsoft, Amazon, and hundreds more. But unlike flashy hedge funds or Wall Street giants, BlackRock didn't seek the spotlight. They didn't run companies, but they influenced them through shareholder voting and behind-the-scenes discussions with executives. If a company needed investment or had to make a major decision, BlackRock's opinion mattered. BlackRock manages nearly $10 trillion in assets, making it the largest asset manager on the planet. That's more money than the GDP of most countries. Their influence is everywhere. Through iShares, they help shape global stock markets. Through Aladdin, they manage risks for banks and governments. And through their shareholder positions, they have a say in how the world's biggest companies operate. But despite their enormous reach, most people still don't realize just how much power they hold. Unlike traditional financial giants, BlackRock doesn't rely on aggressive tactics or risky strategies. Instead, their strength comes from their ability to stay behind the scenes while quietly influencing everything. Whether it's shaping investment trends, advising governments, or helping companies make financial decisions, BlackRock has positioned itself as the most important player in modern finance. But the real question is, how much power is too much? When one company quietly influences everything from stock markets to government policies, it raises a bigger debate: who really controls the future of finance? One thing is clear: BlackRock isn't just watching the world's money move, it's deciding where it goes.